Tariffs are often framed as trade policy tools, but here's what many people miss. Tariffs are also taxes, and they can have serious consequences for business strategy, pricing, and financial planning. A tariff is a tax applied when physical goods cross a border. The amount of the tariff depends on three things: what the product is, where it came from, and how much it's worth. Understanding those inputs is critical. There are three pillars to calculating a tariff. First, product classification, using the global HS code system. Second, valuation, usually based on the invoice price. Third, country of origin, not necessarily where the goods were shipped from, but where they were substantially transformed. One of the most misunderstood areas is country of origin. It's not the last country the product left. It's the country where the essential transformation occurred. Getting this wrong can lead to paying the wrong duty, or losing access to trade agreement benefits. Tariffs aren't part of income tax law, but they influence it. When tariff costs rise, policymakers often respond with tax changes, credits for domestic production, reshoring incentives, and more. So tariffs can indirectly reshape income tax policy, too. Here's something important: the president can impose or raise tariffs without Congress. Through emergency powers, trade rules can change overnight. This volatility creates risk for pricing, forecasting, and financial stability. Can companies reduce tariff exposure? Yes. One common method is first sale for export. That means using the price from the original manufacturer, not the final seller, as the basis for duty. It can save money, but it comes with strict compliance requirements. Be careful. Shifting royalty payments or restructuring flows to lower the customs value can backfire. You may trigger U.S. withholding tax, global minimum tax rules, or anti-abuse provisions like the BEAT. This is where tariff planning becomes tax risk management. Tariff planning can't happen in a silo. Legal, tax, finance, trade compliance, and operations all need to be aligned. Because a change that makes sense for customs might cause problems somewhere else. What are companies doing today? Auditing tariff classifications, reviewing supplier contracts, running impact models, planning for alternate sourcing, and, most importantly, getting their teams in sync. Here's the bottom line: tariffs are not just import duties. They're financial levers that impact your margins, your tax obligations, and your global strategy. If you treat them like just a customs issue, you're already behind.